One of the mistakes I made was I knew that we had to empty the building in order to gut it. So when leases came up, we didn't renew them. So I ended up sitting with an empty building while we were waiting through the permitting process in the city of Chicago, which took about maybe 6 to 8 months. So I had an literally empty building producing no income. And I figured, oh, what a terrible mistake.
What is up, everybody? I am Matt Drouin. I'm the host of the Go Big Live Real Estate Investors Podcast. I am psyched out of my mind today to have Mr. Michael Zaransky, founder and managing principal of MZ Capital Partners based out of Northbrook, Illinois, a suburb of Chicago. But before I launch into his bio, this is the show to watch or listen to if you're an experienced real estate investor looking to scale into larger commercial deals. Michael has an incredible story about his scale journey throughout the real estate and into real estate development, ground up real estate development. He possesses a law degree from Northwestern University and is also a third generation real estate developer, passing it on to fourth generation with MZ Capital Partners. MZ Capital Partners is a third-time Inc. 5000 fastest growing privately owned company, National Apartment Association Best Places to Work in Multifamily. And I am super excited to launch into today's interview. So thanks very much for being on the show, Michael. I appreciate it.
Well, thanks for having me. It's a pleasure.
All right. So first question, you were born, now you're here. What happened in between?
Oh, boy. Something I could never have predicted in a million years at every probably 10 or 20 year milestone. It's been quite a journey. Born and raised in Chicago, Illinois, in the actual city. I'm a product of the Chicago public school system, which means when I got to college, I had to learn how to study and spent hours and hours and nights studying in the library when my friends from the better suburban schools figured out how to get done in 2 hours. It took me 8 hours. But I was driven to get all A's so I can get into law school, which I did. Ended up going to law school in Chicago at Northwestern with really kind of a cool way to go to law school. I didn't intend ever to practice law, and I haven't. I went for the business background, which was great, and learned a lot and a great perspective, and kind of dove in when I got out into the real estate investing business. Started out very small, could never have imagined the product type that I'd end up in or the size of transactions or the type of transactions I would do, but just kind of dove in on a small basis using my own limited capital on very small transactions, caught some lucky waves, and built from there.
I want to dive into, and definitely if you're watching or listening to this, you want to stick around through the entirety of the show, because I want to turn this into a masterclass about something that I'm actually curious about, which is ground up development. Us as a development company, we've only done historic adaptive reuse, nothing ground up. Right now we're in our 1890s built historic skyscraper with no HVAC, so I'm sweating right now. But before we launch into all of that, I kind of want to I'm also super curious about the multi-generational real estate thing, right? The reason why is because every day when I take my daughter to school, we cross a bridge that overlooks the Rochester city skyline. And we have a few buildings that dot that skyline. And when we pass it, I'm like, hey, Holly, you're going to own these buildings someday. And she's like, Daddy, I don't want your buildings. So there's definitely oftentimes a break in between, the generational type of thing. And this doesn't even only qualify for real estate related businesses, but every type of business you can possibly imagine. So I guess what was the seminal moment, or what was the grooming look? What did it look like when you were growing up? And what was the seminal moment where you're like, yeah, I want to do this real estate thing?
It's funny. I had similar memories that are really kind of vivid that you just shared that you had with your daughter, with my dad on weekends on a Saturday or Sunday, driving down to an apartment building he owned and actually walking the building with him. And I remember him teaching me. He owned one building that was 7 stories. And I'll never forget, he taught me the way you walk a building is you take the elevator up to the top floor and you walk floor by floor walk through it and walk down the stairs all the way down, and and you see everything in the building, then go into the common areas. And I think I enjoyed that time both with my dad as well as the marvel of the business and owning the building. And then through high school and college, in the summers, I kind of worked, and I went and I drove, and I picked up the paper applications that applicants would have to fill out because there was no online or internet stuff, and brought them back to the office to be looked over and credit checked, and then a lease actually typed on something called a typewriter, which some of your listeners may have to look up what that is, and then deliver back down the lease. And over a couple week period of time, rather than instantly in the middle of the night, a lease got executed. So I liked that, and I liked the grandeur of the buildings. And then as I got older, some of the buildings were vintage and had some history behind them. So I kind of got into that, and it just seemed like natural for me to both gravitate towards the real estate business, number one, and number two, the entrepreneurial nature of it. I'm not cut out, and never felt like I was cut out for a 9 to 5 corporate type job or working for a paycheck for somebody. I just had the entrepreneurial drive, and real estate is then and still remains very, very much an entrepreneurial business. Most real estate is owned by entrepreneurs like you and I, rather than the big corporate REITs that you hear about, or the big funds. And it's just a great opportunity. I also, quickly as I got more sophisticated, I realized the amazing business that it really is if you think about it. You can buy an asset by putting some equity in, borrowing the rest from a bank or another lending institution, and then without using your own money, with basically using the tenant's money, which is called rent, pay down and pay off that loan over time and build equity in the asset, and end up owning it at a lower mortgage balance in a market that over time, although it has its ups and downs, also appreciates in value. There really is no business that I've discovered or have friends that are in, even though they do very well, that works that way. Plus, of course, there's the tax benefit of the depreciation that comes with it, and a lot of the cash flow coming out of the property being sheltered from income tax.
So let's parlay this into your son. How did you get your son on board? Like, what was your sort of like grooming process? Was this something that was intentional or something that happened by accident?
I exposed my son to the business in an intentional way. I, had hoped he'd be interested. When he went to college in the summers, he did various internships at real estate companies, including CBRE, because he was interested in real estate. And he actually, after he graduated, wanted to come directly into our business. And at that time, our business had gotten large. There was room for him. There were places for him. And my wife, who's actually smarter than me at this, suggested that maybe it's a good idea for him to work somewhere else first, to get some experience and to get some credentials and credibility as not just being the boss's son coming into the business. And it turns out that was great advice. He ended up working for another apartment firm for 4 years, did very well there, learned the business, and then came into our business after that 4-year stint as an experienced and respected and credible partner, and did well with it.
Oh, excellent. I can only hope to work alongside my daughter or son someday. So let's talk about your scale journey, because you may have started with a smaller deal and you were bootstrapping and that sort of thing. So let's talk about the first deal that was a stretch for you, where maybe you didn't have the money to take it down, and how you put that thing together. Tell me about the origin story of that deal.
I guess the first, I did. Before that one, I did some really small stuff. Like I bought individual condos and rented them out. I could swing that on my own. And And I decided I want to get more active, and I looked at emerging neighborhoods in my own local market for starters. We've since gone beyond that in Chicago that were kind of emerging. And it was at a time when condo conversions of buildings were very popular. Everything was selling at full list price. And I found a six flat in a gentrifying up and coming area on the north side of Chicago. I think it was, as I recall, a $650,000 purchase price. That building, by the way, had I just held it today, is probably worth about $3 million. But that's we all have the story of I should have never sold, but you do. And uh, Converted that building to condos. I did not have at the time sufficient money of my own to buy the entire project. So I took a partner in the deal, just one single partner who was kind of passive, and split the profits on the deal. It worked out very well and oversaw the conversion of the 6 units to condominiums, emptied the building, actually did a full gut rehab, and learned a lot about the construction business and a lot about plumbing systems and mechanical systems and getting permits and hiring architects. It really was kind of a babe in the woods, made a lot of mistakes in hindsight, but I was not smart enough to know at the time they were mistakes. And I was lucky enough, total luck, not strategically, to hit a market that was accelerating in terms of condominium values and the popularity of the neighborhood that I selected. The sales prices ultimately, when the conversion was done about a year later, were substantially higher than I originally figured they would be. And all 6 units sold very quickly within a really short time at the full list price. That was the way things went then. I became a real estate broker, a licensed real estate broker, and an MLS member in order to list the property directly on the multiple listing service. And my wife and I actually had Sunday open houses where we showed the condos. And we did that so that we could keep half of the real estate commission. We didn't sell a single one on our own because we didn't have any clients, but other brokers brought us clients and we cooperated with them. And it was kind of my initiation into the first big deal. And that led to other larger condo conversions and ultimately investing in stabilized multifamily projects.
So let's talk about the origin of the actual deal itself, and then also the origin of this partner that you brought on. But like, where did you find this opportunity? Was it listed in the MLS? So was it something that you were driving around or walking around a neighborhood, you saw an opportunity and you contacted the owner? Tell me about that.
Yeah, it was actually listed on the MLS. Smaller apartment buildings tend to get listed on there. And I went and saw it, liked it. And it was really right in the pocket of the neighborhood I had targeted for future growth. You could see things were taking off. At that time, my placeholder was, is Starbucks opening there? And Starbucks was opening, 3 blocks away. Today, you can't do that because Starbucks opening everywhere. So you need other shortcuts. But that was a big deal. Back then, it was in the early 90s. Things, one of the mistakes I made was I knew that we had to empty the building in order to gut it. So when leases came up, we didn't renew them. So I ended up sitting with an empty building while we were waiting through the permitting process in the city of Chicago, which took about maybe 6 to 8 months. So I had an literally empty building producing no income. And I figured, oh, what a terrible mistake. But as I mentioned, by like total luck, prices were appreciating so much that delay made us money. It ended up working out. It was a fun deal. I mean, it was back in the, as I'm thinking back and reminiscing, it was back in a day where I literally had my contractors, and I literally would be stopping at Home Depot or at Lowe's desk, the contractor's desk, and picking up fixtures for them and picking up supplies. And I'd drive there every day, and I was kind of their gopher to bring them the supplies that they needed.
So where'd the money partner come from? Was this somebody you just met off the street, or was this something, a relationship that you had before? Like, tell me tactically, how you positioned yourself to bring this person in.
Yeah, I mean, it wasn't huge money, and it was just like a family friend that I've known over the years and knew and had indicated an interest in investing in real estate if an opportunity ever arose. So that's how it worked.
So family friend, were you? One of the things is that a lot of people have their real estate investing business as like a side hustle that nobody knows about. So how did this conversation sort of bloom? Were you kind of out there evangelical, telling everybody what you were doing in your smaller investing deal space? And kind of like, what did you learn from you're applying now that you learned from that experience in the capital raising space?
I think organically, it's a good idea to let people know what you're doing. Not promoting it, but just let them know what you're doing. Let them know of your successes. I talked, freely about what I do for a living and how the market's going and things like that. And organically, through friends and family, as well as through networking, which I highly, highly recommend, either through volunteer work, not with the end of making money at it, but it's just a good way to be out there. The local chamber of commerce, other business groups, to just put the word out as to what you do. And organically, what I have found is the best way to build a base in capital raising is for people to voluntarily say, hey, if ever you have a transaction and you're looking for an investor, I'd love to be considered. I don't think I've ever proactively in your face said, would you be interested in investing in my deal? And then those people refer other people. We just finished a capital raise for an acquisition of $20 million of equity that we were able to complete and raise in 2 weeks. And I couldn't have done that then. I'm just giving you an example of how it builds and what you end up with. But that's what could happen if you do it little by little.
Absolutely. So are you ready to be our professor in ground up development for like a little mini masterclass?
Sure.
Okay. This is something we haven't had a guest on yet. And selfishly, I want to know, right? Because I've looked at deals that are historic adaptive reuse that we've completed successfully and nothing ground up and that sort of thing. So let's start, I guess, in the site selection process and targeting area and certain metrics or sort of, maybe I hate to use hard and fast numbers, but sometimes we just have to use them to, have something on the back of an envelope to use. So let's talk about the site selection process. What you look for. It's not the Starbucks anymore because they're everywhere. So what is it?
So, here's the deal. The real key is the level of rents in a particular submarket, which is really important. And that combined with occupancies of existing product. And also, very importantly, which people too often overlook, the amount of new supply that's entitled and coming into the market. And all these factors and all these items are now readily available through CoStar or RealPage and a combination of others and census stuff. And just to really learn the market well that you're in, that you've targeted for growth, and not just take, for example, boy, everybody's moving to Austin, Texas or Nashville, Tennessee. That's where I got to build because, to short circuit through all the other data, if you did that, what you would find is there's way too much product there. Rent growth is either flat or negative, and there's a lot of vacancy because a lot of the institutions have put money in there to build new developments, and you're competing against that. But there are other areas that are either very stable or growing where people want to live, where there's land available, and where rent levels are high enough and occupancies are high enough that you can do a reasonable projection and get comfortable with the risk that once you build this thing, you lease it up. And it certainly is more risky than buying existing stabilized assets. So you have to be able to check all those boxes before you go for it. The upside of development that I've found is in very hot markets, which we're not in now, by the way. It's difficult to make development, but this cycle goes like this. It's coming back. In very hot markets, it is difficult to buy existing stabilized assets that are producing an income stream at a really good price that's below what the cost to build it new. Let's flip-flop a little bit now. But the really good part about it is in development, you can often build a product, get it stabilized, get it rented up, and it's worth substantially more than your all-in cost to build it. And you don't have a lot of competition. It's a slower pace on tying up the land, on getting the entitlements. It's not like a bid process and then where there's a best and final that follows it. You got to emerge as the best buyer. You can do it at a slower pace, spend a little bit of money and chase costs at each step as you go. And you can end up building a product and get in at a better yield than what you have to pay for it once it's stabilized.
Excellent. Now to go back on the site selection process there, I mean, so occupancy in an area, right? I have a tool like CoStar that I use for that. What type of occupancy range do you want to see? And I guess, are you looking at the higher band of the classes in a market to see what the occupancy level is at that level? And then, what's that kind of range that kind of at least raises your eyebrow and, hey, there might be something here?
Right. Well, certainly 95% and above is like the gold standard of what you want. But I would, to your point, you really need to look at a product. There's a lot of talk and noise about some people wanting to build product that caters to the B or workforce housing. But in today's construction costs and land costs and interest rate, it's really impossible to build anything other than an A product. By the time you're done with it, it's A quality in terms of the cost. So I would look at those at the occupancy in A product. If it's 90% or below occupancy, that means it's a market that has too much product. And I'd look at the price per foot for the rental as well. But the occupancy number is 95% or above in the type of product you're developing. And like the general, slogan of real estate is location, location, location. Your location has to be good or better than the other product.
You found a site and you're like, okay, the market's speaking to me here. I don't see, I'm seeing good absorption here. I'm not seeing a ton of new supply coming down the pike. How do you even establish what type of basis you need to have on an acquisition of, like, let's say, a piece of dirt? Because that's something that's really, really confused me. For instance, it's like, okay, I have a 5-acre parcel here. I maybe think I might be able to put, 25 multifamily units, garden style apartment deal. I have no idea what to pay for this thing. How do you run those numbers?
You have to do the whole pro forma, and you really have to start with what the rent is going to be. And we like to do current untrended rent just as a safety valve, even though by the time the thing's built, it should be higher. We do untrended rent. We do an actual pro forma of all of the income and all the expenses once stabilized based on our knowledge of the market and comparables and talking through with local appraisers and other operators or third party managers. We get a pretty good feel for what the net operating income once stabilized will be. And then in our case, and in most ground up developers' case, we need to be all in the deal. Hard costs, land costs, and soft costs, as well as the interest carrying costs, at least building to a 7 cap. So looking at it as if it were an acquisition, once stabilized, and then the all-in price, just looking at land alone or building cost alone is impossible. You got to put it all together. We will do it if we can build to a 7 cap, which compensates us for the risk. Some developers and even us for, something we get super excited about in a great market in today's environment, will go down to like a 6.5 cap as a yield on cost, it's called. That should be sufficient. And you also want to make sure you're in a market that stabilized product is selling at a more aggressive cap rate than you're going in all in cost. There's really no per unit piece of land shortcut that works without the other parts of the equation.
Absolutely. And in pro-forming this thing, what type of expense ratio are you usually applying against the top line projected rents?
Yeah, it's going to vary depending on where you are, but generally, new construction is going to be lower than an older building. So somewhere around 35 to 38%, whereas a stabilized property might be 40 to 45. And that really stands up over the test of time pretty well. If the expenses are lower, you're missing something,
Mm-hmm.
or and whenever I see a deal presented, as an acquisition where they have expenses that are lower than that, I know it's some broker put something together that's not reality.
Oh yeah, we see those all the time, all the
Oh, yeah.
time. Yeah, pro formas, broker provided pro formas. There's another word for it. It's lies.
Yeah.
And I can say that to the brokers out there because I'm a former recovering real estate broker myself. So
I'll
um,
tell you, it's funny. That's the one part of our business that is totally unregulated. It's like the Wild West. What brokers could present. Everything else, including what you give a bank, all the lenders, investors, is regulated. But that's still the Wild West. So be careful on that.
So speaking of the top line, I mean, there's a lot of developers that do this, and they're looking at rent comps, and they're like, okay, well, there hasn't been a new product supplied to this market in, like, let's say the last 3 years. So I'm going to put a little bit of a premium on what comparable product is trading, like, because my project's going to be the new kid in town. So I'm going to mark it up. Like, what's your methodology for building out that rent roll on that property?
Yeah, I mean, I don't particularly love a submarket if that's the case, where there's no other new product, because it really hasn't proven that the market could absorb that. But if it really looks like the demand is there, I'd be really, what I'd first do is make sure that the income levels within, let's say, a 3 mile radius or even 5 mile radius of the property, also readily available, can support the kinds of rents that you're talking about. And we, like everybody else, we use a 3 times income level of rent as what's comfortable. So you really have to look closely at the comps, more than just the CoStar report. Got to drive by them, maybe tour them, and see if your product's really that much better. And then if the income levels are such, you can make certain assumptions based on other markets. But it could be, if the other product there is really older, 70s, 80s built, lower ceiling heights rather than 8-foot ceilings rather than 9-foot, let's say, which is the new standard, there could be rent premiums as much as 150 or 200 a month on a 2-bedroom unit.
Yeah, the dilemma that we have in Rochester, for instance, is, like a lot of other Rust Belt communities across the nation, is that we have, we definitely have a tale of two cities in our community, right? We have a lot of wealth in Rochester, and we have a lot of poverty. And what our market has done is we do not have a lot of new rent comps, because Rochester was a very, very wealthy, well-to-do place around the turn of the century, and then kind of carried a lot in terms of through the FHA and suburbanization and that sort of thing. So it's difficult to really put your finger on what your pro forma rents are going to be. And then for the limited amount of new product that comes in the market, you look back on that may have gotten completed 12 months ago or 24 months ago. You look at their total all-in basis from a hard cost standpoint, and you're like, oh my God, well, my costs are going to be like, 10% to 15% more than that guy. So how do I actually, read the tea leaves, so to speak, on whether the project is going to be viable or not? And that's the condition with our market and a lot of markets, and especially in tertiary markets throughout this country. So what do you say to that?
Yeah, it's a challenge, the tertiary markets, especially, and also the rent levels tend to be lower. New ground up development is tough. What we have found most successful in the ground up development we have done that penciled and made sense is suburban garden style apartments where land is a little bit cheaper, where you have 2 or 3-story walk up construction without high rise development, non union, and where the building is stick built with wood rather than steel or concrete construction, which you tend to find more so in urban areas as a requirement, so that the overall construction cost is lower. And in the right suburban market surrounding a larger major city or a growing city, the rents are going to be higher than a market like Rochester. It's tough to make it work in a market like you're in.
Got it. That's why we don't see a lot of new product. But when new product does get produced, I mean, the lease up is incredible, and the developers are always leasing up above their pro forma as well. So let's talk about, you kind of made heads or tails of this piece of land. All right, we can do a project there. How are you negotiating the contract, or what's your framework for negotiating the contract in terms of allowing yourself a certain amount of due diligence? What are the contingencies in this deal, and length of time on that, in terms of how you generally structure these transactions to give yourself an out if this thing is going to end up being a landmine?
Right. Well, one of the things that's less stressful about development is the process you just described, because land sellers in that community expect long contingency periods, both for a combination of due diligence, which comes fairly early on in terms of environmental and doing some surveys to see how many units you can really get on the piece of land and things like that, but more so the entitlement process and getting the project approved by the municipality you're in for zoning to build a number of units that you need. So owners know that's a long haul, and that is a total absolute contingency. It's a negotiation as to how long that will be. And some of that is educating the seller, if necessary, on what the process is, how long it takes. Usually is a number of hearings at different panels, a planning commission and a public comment section, and then to the final approval of the city council. So we get long contingencies for entitlement. They could be up to 6 or 8 months, with the right to extend them if the municipality is taking longer. But that's fundamentally important. It depends on the piece of land and where it's at, how competitive that negotiation becomes. If there's other buyers, some sellers will want some hard money up front, regardless of what happens. Others will make the earnest money deposit entirely contingent. We try and negotiate a full contingency on our earnest money if possible.
Yeah, I know that I've heard in your other interviews that are out there on, and before we wrap up this show, we might need to do a part two on this. But before we wrap up this show, I want to go into the entitlement process and your methodology for that. I've been involved with development projects. I used to be a director of operations for a national real estate development company, and it was my job when we had a vision for a project to go kind of like through priming the community. And my bosses were like, "Why are you going to the neighborhood association in this community to present our project? It's not even, we don't even have our application in yet." And me, with living in an urban environment, so because we invest in urban environments, a lot of times communities are very, very skeptical of the big bad developer coming in and what is this company going to do to us. And so I wanted to kind of go in and, hey, here's like a very, very sketchy rendering of our project. This is going to be the size of it. These are the type of apartments and that sort of thing. What do you think? I can't take all of your input into consideration and applying it to the development project, because obviously this thing has to be financially viable for us and also just doable from a zoning standpoint. But I found that actually, allowed us to remove a lot of the barriers. So we actually had the public application process and the hearings, that we had a lot less friction involved with that. So kind of walk me through your company's methodology on getting the entitlements.
Yeah, we actually very, very much agree with your approach. I think you're right on. I think too many developers ignore that. You're starting out in a situation where as soon as the neighbors hear of the project, and they'll hear about it either informally and then certainly formally as an application gets made, neighbors within a certain radius, varies by municipality, get noticed. They're invited to come to a hearing. As soon as they learn about it and they hear about it, they hate your project. They hate renters coming into their neighborhood, especially if they're either homeowners or condo owners. They hate traffic, and they hate the stereotype of a tenement going up in their backyard. They're the NIMBYs, as we call them, not in my backyard. They're all for renters, but not in my backyard. So you're starting at that basis. So rather than just confront all of these irrational objections at a public hearing, we like to be proactive, and we reach out to the neighbors. We used to actually do it in person. We would host an evening either at the local public library or at a community center, where we would have all the information about our project up on poster boards with nice photos. We talk a little bit about our history. And we also try very much to connect on a personal level to let them know, in our case, that we're not just some large corporate developer, that we're a family business, that we give back to the communities we invest in, and that we build really, really nice product, that we're not looking for low-end garbage, that we maintain and professionally manage our product. And by the way, we have a professional traffic study, and the certified person that did the traffic study is here tonight to answer any questions and tell you about the relatively minor, if any, impact on traffic in the neighborhood by doing this lower density development. We try where possible to present less units than are maximally allowable under the appropriate requests that we could request for in zoning, and tell the neighbors it could be larger, but we've decided to downscale it. In our case, because of the type of product we like to develop, we can show them that it's only going to be 2 or 3 stories. It's not going to be a high rise, and there's going to be plenty of parking on the property to cover everybody's cars. They're not going to be blocking your streets, and we connect with the people. And of late, during COVID, we started doing this by Zoom, and we've kind of remained doing it by Zoom. You get more participation. It's easier. You get less of a gang mentality ganging up on you at an in-person meeting. You can mute and unmute when you want. And it's gone very well. And the public hearings vary. We are also proactive on the municipality side, where we go in and we meet with the city planners. We meet with the staff person that staffs the planning commission. We try and meet with the mayor and the city manager, if there is one, explain our background, explain what we're doing, and kind of get their support to see the benefits before we even go to that process. It's also helpful just to say at a hearing that you've reached out to the entire community and that you had an open forum and explained it to them. Even if they don't show up, commissioners, before they vote, want to know that the community is okay with it.
Absolutely, yeah. I mean, the technology is definitely great too, because you can do that, record that Zoom, and throw it right up on your YouTube channel or something like that, so that people can document that. So, and then also on the point of anticipating objections rather than trying to overcome objections, it applies across not just through your entitlements and approvals, but even in raising capital, for instance, is anticipating those objections that your investment partners might have in this. So to close this out, I mean, the great time to be raising capital is when you don't need it, and clearly right now you don't, because you finished a raise. But what's your advice to those people that are watching or listening out here in terms of how they can position themselves to raise capital for their deals, regardless of the size, from now and in the future?
I would start by establishing some track record, even if it's really, really modest. Even if it's fixing up single family homes and renting them and selling them one at a time, or condominiums, or some other product, or a 2-flat or a 3-flat. I think it's very good to have a track record, whatever it is. And then to explain to the network that we talked about in advance, and start to compile a list and start there, that you now have a larger deal that's available, that you're trying to put together a group and put together a really nice brochure that describes the investment and the philosophy behind it and the opportunity, and go from there. I think you'd be surprised at the demand from people that you have credibility with and a little bit of a track record of their wanting to be in real estate. Investors who are sophisticated and have some money already know the advantage of investing in real estate. They're just looking for a place to do it with, and they don't want to be active in it.
Absolutely. That's great advice. Well, Michael, you've been very generous with your time. I do want to close out with how people can get in touch with you, get on your distribution list for future opportunities with your company. How can they do that?
Best just want you to reach out direct to me by email at mhz@mzcapitalpartners.com. And I'm happy to respond and talk real estate, or any potential deal somebody's working on. If they're interested in me weighing in on it, it'd be my pleasure as well.
Absolutely. We'll be sure to put that in the show notes. Michael, thanks again for being on the show. I'll look forward to seeing you in the green room right after this. If you're listening or watching this right now and you want to get on an exclusive educational, long-form educational, really techie kind of stuff that is outside the scope of this podcast, which is more on the technical side of things in real estate, definitely make sure to subscribe to my YouTube channel and hit the notification button. I release long-form educational videos on how you can scale from residential to commercial. So that being said, Michael, thank you very much for being on the show.
My pleasure. Thank you for having me. Take care, Matt.